Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There were only two sectors in the S&P 500 where you saw negative earnings growth. You saw positive earnings growth north of around 10% for 5 of the different sectors, which was a big improvement in terms of breadth versus Q1. We need to see that continue to broaden out as you look at Q3 earnings season, which should be on the docket here in the next few weeks for reporting purposes. You know, that to me is really kind of where we need to see the fundamentals pull through for the market to continue to move higher.
What I say about the AI rally is that whoever you are, retail investors in general, unless you're invested in something with very high tracking error to the market, you have a ton of exposure to the AI rally. You don't need to do anything more within your portfolio to lean into the AI rally, because all of those big tech companies, and we know that the index is very, very concentrated at this point from a historical basis, you're getting a ton of investment in AI, whether you asked for it or didn't ask for it.
What the typical American needs to keep in mind is the amount of our economy that was based on trade was only about 16%. Flash forward to current markets and we're more like 28%. So this would be a huge hit on the economy. I really hope that both sides can come together. Right now, it looks unlikely to be happening today.
We got 1 hour to go until the market close, so we're taking a look at the major averages here. It's been a pretty eventful session, especially in the last hour or so of trading. That's because Jay Powell was speaking, both gave a speech and then did a Q&A. And you see the effect on the market here. That downswing was when he seemed to indicate here that they were going to go at a slow pace of interest rate cuts, maybe even just 25 basis points between now and the end of the year. And the drumbeat had been kind of, maybe there was going to be more. Raphael Bostic talked earlier today and seemed to indicate that. But then we did see a little bit of a recovery here. Right now, the Dow's only down about 220, half of 1%. The S&P is only off about a quarter. It had a very similar motion there. And the Nasdaq, similar as well, but only down about a quarter, 1%.
Yeah, it was interesting because Jay Powell says, listen, over time, we'll move to that more neutral stance. We're not in a rush to do so, and maybe that's where you saw that dip, Julie. And strategists were pointing out markets priced in a lot of cuts, and so does his commentary kind of line up and match up with those expectations as part of the reaction you saw? Some of his other bullet points were really kind of re-emphasizing stuff we've heard. Right. So the overall economy is solid. The labor market said solid but cooling. So re-emphasizing some prior commentary as well.
Yeah, we're going to get more details on what he said in just a few moments with our Jennifer Schonberger, but we got to talk about a couple of other things when it comes to the markets. First of all, it's the last day of the month. It's the last day of the quarter. So if you look at, let's say, the month to date here, everybody talking about September usually being so terrible. It wasn't so terrible. In fact, it was up on the month unusually, and it is now 10 of the past 11 months that we have seen an increase for the S&P 500. And then if we look at the quarter as well, we are setting up for the 4th straight quarter higher for the S&P 500.
And you could make the case, right? Because you ramped into a Fed meeting where you expected a cut and you got a cut. You actually got a supersized cut. The economic data has been, you can argue, decent. Jay Powell just told you the overall economy is still solid.
Yeah.
And you could make that case if you look at jobless claims or retail sales, and earnings growth has been decent. And the expectation, I think this is really key for this market too, Julie, the expectation that earnings growth is going to really broaden here beyond big tech, also a big tailwind.
I mean, you look at the equal weight index too, it's done even better over the last quarter. One more thing that I just want to mention quickly, because this is something also that helped lift us to the end of the quarter here, and that is, if I can find it on our screen, China stocks. Now this is looking at the 1 month, and you can see some big increases here. The Shanghai Composite just had its best single day performance since 2008 after yet more stimulus was announced in China. This one having to do with housing specifically and refinancings being allowed. And so we saw a big lift for China. BlackRock coming out and saying now they have a slight overweight in China. So that was an interesting
that's
reaction.
become sort of a battleground. You have very smart investors, some big name investors who come out, pounding the table. They're all in. Of course, we've also had smart strategists come on Yahoo Finance, Julie, and say, exercising, I think, some caution, saying we've actually seen this before in the spring. Stimulus is announced, you see a rip and then it fizzles.
So we'll see if it works. All right, let's get more on the Fed now. Federal Reserve Chair Jerome Powell just wrapping up a speech in the run-up to the crucial monthly jobs report coming on Friday. Yahoo Finance's Jennifer Schonberger joins us now. She's been monitoring those comments. So Jen, what did you hear?
Thanks, Julie. Fed Chair Jay Powell says the Fed intends to do what it takes to keep the economy humming and avoid recession, but pointed to cutting interest rates in smaller increments.
Overall, the economy is in solid shape. We intend to use our tools to keep it there. We remain resolute in our commitment to our maximum employment and price stability mandates.
Speaking of the National Association for Business Economics annual meeting in Nashville, Powell said if the economy unfolds as expected, the Fed will cut rates, quote, over time toward a more neutral stance. The Fed chair said the sense of the committee is not one that wants to cut rates quickly, though he added if the economy slows more than expected, they can cut faster.
We will do what it takes in terms of the speed with which we move. When we wrote down our SEPs and made our decision, it was a situation where people were thinking, the bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s.
Powell noted that the risks are two-sided now on inflation. Powell said recent inflation data indicate further progress toward a sustained return to the Fed's 2% target. He says the job market doesn't need to cool more for inflation to continue falling back to 2%. And speaking of the job market, while it has cooled, Powell characterized it as, quote, solid, pointing to low levels of layoffs and saying that the unemployment rate right now is right in the range of what's considered full employment. Guys?
And Jennifer, what did you take away on the size of rate cuts ahead from Powell, and also what we heard from Fed's Raphael Bostic today about another possibly 50 basis point cut?
Yeah, Josh, you and Julie were talking about this earlier in the program. And certainly Powell pointed to the SEP, and the consensus seems to be for a more measured pace, looking at perhaps 2 more 25 basis point rate cuts. You heard him say we're not looking at 50s. But one person who may be looking at 50s is Atlanta Fed President Raphael Bostic, who told Reuters in an interview earlier today that if we were to see the job market data deteriorate between now and the November policy meeting, he would be open to a 50 basis point rate cut then. Keep in mind, he said that he had only penciled in 1 more 25 basis point rate cut this year. So just proof that the SEP, these interest rate projections, really much like a snapshot in time. This Fed very data dependent. Guys?
All right, Jennifer, thank you. Appreciate it. Now, for more on what's ahead for the Fed and what it means for investors, we want to welcome in now Sandy Villery, Portfolio Manager at Villery & Company. Sandy, it is good to see you. So we did hear from Jay Powell today, Sandy. Said, listen, the Fed over time is going to move to that neutral stance. They're in no hurry, though, to cut quickly. Reiterated the economy overall, he said, was solid. Labor market, he said, solid but cooling. What did you learn today, if anything, Sandy? Did you hear anything that surprised you from Jay Powell?
No, I mean, he said he's on no preset course. I mean, the way I look at things right now is that you really don't want to fight the Fed. If we're talking about another 25 basis points in November, another 25 in December, we haven't spoken about 25, but you could get another 4 25 basis cuts in 2025. So when we look over history and you go back to 1950, stocks in general, large cap, have been up 15% on average after that first cut 12 months later. Small cap up about 27%. So I think the wind is at our back, and I think we can use some volatility in October going into this election to buy some great companies at reasonable prices.
Great companies at reasonable prices sounds like value. You guys are value investors, if I'm not mistaken. And we've talked about this before, that value investors have been calling for the return of value for a while. It hasn't quite materialized, but last quarter, the quarter that's ending today, the Russell 1000 Value Index did outperform the Russell 1000 Growth Index, about 8% to 2% or so. So is that the beginning of a turn, or are we still going to see some sort of fits and starts here?
Yeah, I think it's a great opportunity to add to either large cap value or also small cap. And I think, when you look at what did happen in the quarter, small cap's going to be, maybe it's up a little bit under 9% with the S&P up, about 4.5 or so. So I think you're going to see more of that play out over the next 12 months. So it's a good time to be, positioned in a lot of those businesses. And specifically, we do like names that are exposed to the consumer, because I think they've been sold off a little bit more than they should have when people thought we may be going into a deeper recession. And maybe that looks like, according to Powell, we look a lot more clear on that front. So we like some of those, smaller names, maybe exposed to the consumer. And then we also like the large cap value bucket.
Is there a consumer facing, small cap name, Sandy, that you'd want to highlight?
Yeah, we still like Caesars. They have a pretty good bit of leverage, 84% debt to cap. But when rates come down, that could, really be like pouring gasoline on the Caesars fire, if you will. And we think that looks pretty good. Best CEO in our mind, Tom Reed, does a great job. I'm here in New Orleans. They're going to have the opening of the Caesars converting from Harrah's right here in New Orleans in October, going into the Super Bowl. So I think a lot of good things in store for them, and we like that name.
What happens to gambling trends in an economic downturn, even if it doesn't turn into a recession? I mean, we already know that lower income folks are being hit harder. They have been hit harder by inflation. How does that sort of match up with what we see, particularly with regional and domestic gambling trends?
Yeah, I think the regionals are holding in there fairly well, and they've got a lot of exposure there through their old ownership in El Dorado that's now part of the Caesars family. So I think when you look at Las Vegas, we do need more to come out of China. We're seeing a lot of stimulus, but we do need people to come visit Las Vegas and that sort of thing. At some point, we're hoping that they can get some sort of asset sale done, but the prices have been so just not favorable for them. So hopefully lower rates equals a better real estate market, and they could get something like that done. I'm not saying over the short run, but that is something that's something we can look forward to.
Sandy, another big trend I want to get your take on, Chinese authorities coming out and announcing stimulus. Obviously, investors got very excited and jumped in. I'm just curious, Sandy, how are you thinking about that as a strategist? What do you think it ultimately means for the Chinese economy and markets?
Yeah, I think that's just another thing that's going to, help our markets, actually. We do own some Freeport-McMoRan, FCX, and 52% of the world's copper demand is coming from China. So we think between the electrification of the world and hopefully more construction and, building out artificial intelligence warehouses and things like this, and certainly electric vehicles, that there's going to be a little bit of a tailwind behind copper. And so we like that coming out of, with more Chinese stimulus. So that's another name, a little bit larger market cap, 70 billion, but something that think's got definitely the wind at his back as well.
Sandy, good to see you. Thanks a lot.
Thanks. Take care, Julie.
Take care. We're just getting started here on Market Domination. Coming up, shares of Stellantis riding downhill today after the car maker slashed its earnings forecast amid rising competition from China. We're going to check in on the company as well as some of our other top trending tickers. Plus, which U.S. company has the greatest degree of exposure to China? We will tell you later in the hour. The answer might surprise you. And Carnival shares lower after their latest earnings. We'll speak to the cruise liner CEO Josh Weinstein at 4:30. Stay tuned, all that and more when Market Domination returns. Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session and those that are most clicked on Yahoo Finance's trending tickers page. First up, let's take a look at NVIDIA. Those shares are under pressure. Now, Beijing is reportedly urging Chinese companies to seek AI chips produced locally instead of using NVIDIA. That's according to Bloomberg. Those shares down just about 1%, though. So we already know that there are curbs on what NVIDIA is able to sell into China. And so NVIDIA had developed a less advanced chipset that it could sell into the country. It is that less advanced chipset that is reportedly what's being affected here, the so-called H2O chips, that China is informally trying to encourage homegrown companies from not buying, to help them buy domestically produced chips instead.
Yeah, the reports made it sound like, I mean, this was guidance, not some kind of like formal ban by the CCP. It is interesting because we saw Chinese government tell local EV makers, remember earlier, procure more of your supplies from local chip makers. So you do see this thing, obviously the government there would trying to get its companies to, I guess, rely more on the local choices, local alternatives.
Yeah, it was also interesting. I saw a note from UBS's Timothy Arcuri, who said that his office, his desk has gotten a lot of requests about information about whether the Department of Commerce was going to, on its end, impose more export controls on NVIDIA and other companies. And so he said it's a possibility that there might be curbs on high bandwidth memory to China. So all of this something to keep an eye on. And Micron, by the way, I noticed is also down today, which is a maker of that type of chip.
Yep, interesting. All right, another trending ticker we're watching is CVS Health. Company facing the potential start of an activist stance from hedge fund investor Glenview Capital. This is according to Wall Street Journal. So this shares popped about 2.5%. Reports that executives going to meet with investor Glenview Capital on how it can improve operations. Glenview founder Larry Robbins now has what sounds like a significant position in this name. Per the Journal, CVS now represents really about $700 million of Robbins' $2.5 billion fund.
Yeah, and the Journal's also saying that the company is cutting staff, about 2,900 roles being cut, mostly from the corporate ranks. It has been, though, a tough environment for companies like CVS. You see this with Walgreens as well. You see it with the health insurance companies that have been seeing expenses start to tick up. And so some of the issues might be specific to CVS, and Robbins can put pressure on them. And some of them do seem to be more sort of industry-wide issues affecting the insurance industry.
Yeah, I mean, so it popped a bit today, but as you noted, Julie, it's been facing real headwinds. It's down about 20% now this year. And I did see some analysts quoted as saying that, it operates in obviously very regulated areas and sectors. So even if you were to see change, I think their point was you would expect it to come potentially relatively slowly.
Right. And where would that upside be? It'll be an interesting story to watch. Shifting gears now to our next trending ticker, it is Stellantis. Those shares are tumbling after it issued a stark warning about the North American operations. Yahoo Finance's Prasubramanian has been keeping busy lately because Stellantis is only the latest of the automakers to cut its outlook.
Yeah, that's right. Stellantis, at least in the U.S. here, we've heard some issues sort of percolating with dealers complaining about unsold inventory, heavy discounting, things like that. And finally, the company had to sort of say, we're going to have to take some remedial action here, and that's going to cost us. Basically, what they're going to do is they're going to cut shipments to their dealers by half. To now they're cutting 200,000 new cars dealers in the U.S. by the back half of the year. That's going to lead to some cuts in their margins from 5.5% to 7% from double-digit teens before, and then industrial cash flow now is going to be negative compared to what they said was positive. So some big effects here for them with cutting supply and doing these cost-cutting moves, things like that. A lot of heavy discounting, and Stellantis CEO Carlos Tavares is under a lot of pressure to kind of right the ship because, like you mentioned, Julie, it's not just him. It's Volkswagen, it's also Nissan, a lot of major automakers struggling
Aston
with.
Martin,
yes.
also today.
Struggling with the EV transition, and Aston Martin, different story because they make these sort of smaller and low volume vehicles. But yes, definitely, they're in the process of converting their business.
Isn't it also with Stellantis? Isn't the UAW potentially thinking about labor strikes as another potential challenge there?
Yeah, that's one other issue that they're dealing with right now is a plant in Belvidere, Illinois. Is they promised they'll reopen it, have some other projects there. That's been kind of in limbo. The union thinks that that's not going to happen, and so there's threatening a strike with Stellantis at this point. So we'll see if that comes to fruition. But We saw Ford today, GM today, even Toyota kind of get hit a little bit based on the sort of sentiment here. I'm not saying they have the same issues, but the fear is that there's caution out there, and maybe spillover effects could happen to Ford and GM with regards to inventories.
Right. All right. Well, we'll keep an eye on it, and we're going to talk more about it right now, in fact. Thanks, Frost. We've seen this wave of weak guidance charting a rough road ahead for auto stocks. Stellantis, the latest company slashing its outlook. And joining us now is Daniel Rosca, who is Bernstein senior analyst who covers this group. And I'm curious, and we've been trying to sort of get our arms around what is happening in the auto industry, particularly when you look at North America versus Europe. Stellantis obviously, kind of straddles the two regions. How are you viewing the differing challenges here?
Hey, Julie. Look, I think the U.S. market has been on a path of mean reversion. Remember how car prices shot up during the pandemic, and it's been coming down ever since. I think the U.S. specifically for Stellantis has seen a situation where Stellantis took prices up far faster than GM and Ford have over the past couple of years. And the product quality really didn't catch up. And that's one part we're seeing right now. In addition to the inventory Prav just mentioned, there is a price correction required here. In Europe, I think we're seeing a more general slowdown of the economy, but nothing like the kind of mean reversion we are seeing in the US for Stellantis. So Europe, while not great, is still on a fairly decent path. And if you look at the guidance that the company gave today, what it actually implies for the second half is that in North America, Stellantis will not earn any money. So margins likely dropping almost to 0% for the North American business in the second half. And that's in stark contrast to Europe, where we're still at 5 to 6%, or also other rest of world markets like Brazil or South America and Africa, where the company is still earning mid-teens margins right now.
And Daniel, I want to ask you about the Chinese market as well, get your take on how healthy that market looks now and ahead, and also whether Chinese buyers, Daniel, are they still interested in American brands? Because I've read some reports that perhaps that interest is kind of waning.
Oh boy. So, well, one good news for Stellantis, they're not that active in China, but the market in China overall has seen a massive overcapacity build from electric vehicle manufacturers popping up left and right. Big names you, of course, know like BYD or NIO. And that has really driven prices down, but it's also really accelerated innovation in the market. And Western cars, across the board, the Europeans and GM, for example, are seeing headwinds in China. And actually on GM, we think that it'll be really difficult for GM to regain its market position because they're lacking the electric tech in China.
And so when you put it all together and you look across the landscape, I know, for example, you recently downgraded General Motors to a market perform. Where are you seeing value that people should be looking to buy right now within the auto industry, whether you're looking at the U.S. or some of these other international automakers?
Look, we still think that there's a benefit to owning Ford at this point. We have an outperform on Ford because their Ford Pro business is really resilient, and they are starting to regain traction in the European EV market, and that will push them beyond consensus earnings on 25. But quite honestly, on the OEM side, so if you're really just thinking about the broad OEM stroke, it's tough, right? Because we are in a stagnating market at this point in time, both globally and in Europe and the US. And so I think if you're looking beyond the OEMs, you really want to think through where are some of the big growth areas. And big growth areas still remain electric vehicles where there is growth, but also increasingly technologies and companies that are geared to plug-in hybrids, where we've seen quite a pickup in demand in the US. Looks like American consumers are much more comfortable going into a plug-in hybrid before really switching to fully electric vehicles. And so I would say if you look beyond the OEMs up the supply chain, then you want to look at companies who are really strong in plug-in hybrids.
Daniel, sometimes you'll see this commentary, kind of a broader question for you, where folks will say that they steer clear of Ford and GM because they don't think those names ultimately long-term are positioned to capitalize on where the industry is really headed, software, autonomy. What's your take on that?
Well, that's a fair argument. The big discussion, if you talk to long-term investors about the Detroit 3, clearly is the terminal value and how much of that terminal value is real. And look, auto stocks, difficult on a 10-year period. I would strongly, our recommendation has always been, look, you want to look at these companies on a kind of 6 to 18, maybe 24-month basis. That's how you need to phrase the investment thesis. If you think about those three challenges, I can only underscore that, right? Traditional automakers need to transform their production from combustion engine drivetrains to electric. And we can argue about the pace, right? It's a little bit slowing down maybe, but the ultimate goal is the same. At the same point, they really need to increase their value chain and their capabilities on software. And I'd even add, it's not just robo-taxis on the end, it's the whole application of AI in the car, right? From how you use that for in-cabin sensing to the car driving itself. And at Bernstein, we often like to talk about the 3 stages of the world, right? Because in China, most of the successful electric manufacturers have mastered EVs. They've mastered software to a great extent, and they're thinking actively about where AI can play a role in the car. I'd say Europeans are 4 years behind China, and so they're making EVs that are profitable. They're thinking about software, but they are preoccupied and don't have that much bandwidth to think about AI. And in the US, if we look at Ford and GM and Stellantis to some extent, they're still trying to figure out how to build profitable electric vehicles. They're 4 or 5 years behind the European space. And I'm just worried that in the very long term, by focusing on the industrial transition, not being fast enough in innovating, these companies ultimately will need to concede market share.
Well, and Daniel, just quickly as well, part of the problem in the US is that people don't necessarily want electric vehicles, right? It's hard to be profitable if you're not also doing the volume that you need to be doing. What do you think is going to be that tipping point here in the US to get people interested again in electric vehicles and get that volume out the door for the US automakers?
Two-part answer. Number one, it's not quite that bad, right? So if you actually look at the data, and we did a really deep analysis on state-level data, we've got a couple of states, New Jersey, Washington State, for example, who are almost California-like. Not quite, but they're kind of on that growth curve of California. And so we see kind of a group of 10, 15 states where EVs probably have crossed the Rubicon, and that will continue to go. So there's a question from a policy perspective, which will be interesting in November, how kind of the other 40 states or other 35 states we have on that list, how they get kind of up that curve. And from a consumer point of view, it's been, the common complaints are 3. Number 1, these cars are too damn expensive. Number 2, they don't go far enough. And number 3, the type of car I want to buy isn't even in the market, right? Think about small crossovers or those formats. All of those are being addressed. It won't be a quick fix. Pricing is coming down and will continue to come down as OEMs get smarter on how to make profitable EVs. Range and charging anxiety should be going down as the cars that are coming to market drive longer and we're getting more charging stations. But we're kind of in a feeling where Europe was 3-4 years ago, kind of in this intermediate stage. And it's going to take 12, 24 months to get through that, I think, before everybody becomes a little bit more optimistic on BEVs again.
Daniel, so great to have you on the show today. Thank you so much for joining us.
Thanks, Josh. Talk soon.
Coming up, which U.S. company has the greatest degree of China exposure? The answer just might surprise you. We'll discuss on the other side when market domination returns.
China stocks extended their stimulus-fueled rally. The Shanghai Composite seeing its largest one-day percentage gain going back to 2008 as Beijing rolls out stimulus measures in response to the nation's economic slowdown. As the country battles to revive its economy, several large U.S. companies find themselves exposed to China's recovery road. Here with more on the highest U.S. exposures to China, we've got Strategy Risks founder and CEO IXIC Stonefish. IXIC, thank you for being here. Appreciate it.
Thanks for having me.
So this report is really interesting because you don't just measure the strict monetary relationship between U.S. companies and China. You try to look at the broader sort of political, reputational enmeshing, right, of U.S. companies. So I guess, first of all, talk us through how you measure that. And are U.S. companies as involved with China as they have been?
Answer that second part first. They're definitely reducing their exposure. We think that's a meaningful trend, and we think it's a heartening one. The way that we measured this doesn't just look at business fundamentals, revenue, but also looks at supply chain exposure, looks at their exposure to alleged forced labor or more direct forced labor in Xinjiang or Tibet. And then I think the most important category that's new is partnerships and politics. When you work in China, your relationship with the Communist Party of China is paramount. And we felt that investors, regulators, and the corporates themselves need to have a much better understanding of what companies' relationship with the Communist Party is.
IXIC, so you're screening for different variables. Is there one category of exposure that you would find the most concerning?
I think it's both regional issues and partnerships and politics. Some of this comes from company disclosures, some of this comes from media reporting, but the concrete ways that the companies are working with the Communist Party, I think is in many cases very material and concerning, and something that folks who are screening these companies or investing in these companies should really look at.
Well, I have to say there's some surprises on this list, at least for me. Ford is the number one company with the most exposure. So what does that exposure look like, and how does it potentially make the company vulnerable?
It was also very surprising to me to see such an iconic American brand at the top of the list. It also, I will add, doesn't mean that Ford's the most successful in China or has the largest market share. It's the accumulation of these various exposure points. And what this means is both Ford is relatively closely tied to China's economic success or failure, but it also means that Ford is vulnerable to folks in the US government or consumers or other parts of its supply chain that might wonder why it's focusing so much on China and what that means for its business in the United States or elsewhere in the world.
You know, IXIC, a big thing we're talking about is Chinese authorities announcing, a range of stimulus to boost the economy, and we're trying to figure out still, I think, kind of long-lasting impacts to the economy and markets over there. But is there a way that you think that could impact these rankings going forward?
I think absolutely. I think as China's economy either strengthens or falters, and as Xi Jinping grows more or less confident, it will certainly impact the way that these companies make decisions about how exposed they are to China. And I think the big thing we're looking at is the November election, and then whether or not Beijing thinks the new president is stronger or weaker and decides to push more against US companies and against the United States, or potentially moves to reduce tensions.
IXIC, is this the first time you guys have done this particular measure?
This is the first time we're releasing the information publicly. We've done it for years and kept it private, but we felt that the information was important to release publicly, both for our clients, but also to spur a debate about how we should talk about this and how companies, investors, and regulators should act as a result.
Well, I ask because I'm curious how much the companies on the list change from year to year, how fluid all of this is.
It's surprisingly fluid, and some of it is, as we continue to put this out and we update our methodology, some of it causes changes there, but mostly it's because companies make different decisions and have different leaders or different geopolitical frameworks that they decide, okay, I'm going to import less from China, or I'm going to open a new factory, or I'm going to sign a new joint venture with a state-owned enterprise. So these things do change year over year.
Isaac, I'm curious as someone who studies, the Chinese economy and market so closely. What do you think 5, 10 years out from now that relationship does look like between China and American companies? How much of an opportunity is China looking ahead? Is it still a big opportunity, or is it smaller, lower margin? What do you see?
So I'll answer that in two ways. First is there's been a really strong leftward turn under Xi Jinping, especially lately, where he's really trying to make the Chinese state control more of the economy and squeezing the opportunity not only for foreign businesses, but for Chinese businesses as well. And if we step back and look 5 to 10 years in the future, the real question for that is, do the United States and China go to war? Does China and Japan go to war? Does the US and Russia go to war in a way that brings in China? Is there going to be a very major geopolitical shock that will just upend any sort of conventional wisdom about US-China trade? Or is it going to be more static and a steady increase or a steady decrease in tensions?
Isaac, always great to have you on the show. Thank you for joining us.
Thanks for having me.
All right, let's get to our call of the day. It's sponsored by Tasty Trade. Raymond James upgrading Frontier Group Holdings from underperform to market perform. The note highlighting near-term earnings momentum. So this one, Julie, did jump a bit today. They go to market perform, so not bullish, but less skeptical, I guess. Talks about positive near-term earnings momentum at the airline, driven, they tell their clients, by favorable exposure to meaningful capacity cuts at Spirit. Also, they say, improving pricing trends in domestic and near international markets.
Yeah, basically it sounds like some of their competitors like Spirit are cutting capacity, and that Frontier could benefit from that, not only picking up routes, but also if there is some pricing power industry-wide, maybe that would help them, even though they are a discount carrier. Also, they cut their jet fuel price forecast for basically the next year or so, or the next few quarters. And so they say that could also benefit Frontier.
Yeah, so why not go to a buy, Julie? Why not go to a buy? They say, while profitability should recover over time, we expect earnings to continue to underperform peers in the medium term, providing less resilience to shocks. Stock is basically, has not done a whole lot this year. It's basically flat, but strong recent move. It's up about 60% now since mid-August.
Oh, wow. I did not know that. Thanks, Josh. Well, nuclear power is making a comeback, with plants in Michigan and Pennsylvania set to reopen to help fuel the AI boom. The energy transition's in focus, not just because of that data center boom and its need for electricity, but also because of the very different regulatory approaches of potential Trump and Harris administrations. Aniket Shah has been researching all of these issues. He is global head of sustainability and transition strategy at Jefferies. Kind of a big scope, big job there,
Aniket.
A
lot of work to do, indeed.
He is here with us in the studio. Great to see you in person. So first, I want to get your reaction to some of these recent nuclear headlines, because, for years there's been sort of talk that nuclear needed to play more of a role, but there wasn't really any movement, either on the regulatory front. It's also very costly to reopen or build, almost impossible to build new nuclear plants.
Yes.
But it seems like AI is the thing that's finally making it happen.
It's amazing. I'm surprised that the world is surprised about this moment. If you go back just 9 months at the COP conference, the US signed on to a pact to try to triple nuclear capacity over the next couple decades. If you look at the International Energy Agency's long-term forecasts of what was needed to get to net zero, we knew we needed to double or triple global nuclear capacity. And at the same time, we knew that there was going to be increased power demand. This is nothing new. This is why looking at the world from this energy transition perspective is really helpful. We all knew that we were going to have more power demand and that nuclear was going to play a role in this. So we've been writing about a nuclear renaissance for the past 3 years. I'm glad that the world has finally caught up to it. It's interesting that it's the AI story that's really catalyzing it. I'm fine with that. I'm, in fact, happy with it. But let's realize this has been long known in the energy transition world, and now we have to work itself out. It has to work itself out, and it's going to happen quite quickly, as opposed to with some planning. And that's quite tragic, because it, in fact, takes many years to get an industry from dormancy to up and running. And now we're going to see that with what's happening with 3 Mile Island and Microsoft, what we heard from Michigan earlier today, and we'll see if it's possible.
Well, how is it going to happen?
Well, one thing that's going to happen is big tech is going to make it happen.
They're just going to throw a lot of money at the problem.
They're going to throw a lot of money, and you see even the early indication is that Microsoft is willing to pay a considerable premium for both firm power and clean power. Of course, remember, Microsoft wouldn't be paying this if it just wanted firm power, because you could go down the path of natural gas. But they want to stick to their climate commitments. So where do you get all this low carbon power? It's going to be nuclear, but at significant premium. We're seeing numbers at $100 to $120 per megawatt hour. That's not nothing, right? So number one is big tech is going to make that happen. And we're also going to see big tech throw money into things like small modular reactors. We're seeing that already. We might even see a big tech throw money into nuclear fusion. We hosted an entire conference on nuclear fusion, which sounds like a science project, but it's actually becoming a little bit more advanced than that. But the second area, this is very important for people to realize, is that there's bipartisan agreement around nuclear in this country.
Right.
You know, we hosted Senator Gillibrand here in New York on our platform at Jefferies 6 months ago, and she was talking about the benefits of nuclear energy. And if you went and listened to Donald Trump on the All In podcast with Chamath and David Sachs and the sort of tech crew, he was talking about being pro-nuclear. And there are very few things that Senator Gillibrand and Donald Trump agree on. So all of this is to say that if you see what's happening in Washington with both parties coming together on nuclear, you see the ADVANCE Act very specifically getting passed in a bipartisan basis just a few weeks ago to speedline nuclear approvals. The building blocks are coming together. Now the question is, can you actually get it done?
Right.
And getting it done is going to be hard. It's going to be long. In fact, the United States, we don't have the skills and the capacity to do this right now. So a whole industry needs to get formed, and we get to see it in live time.
Okay, so if I'm an investor and I'm saying, okay, I'm betting on the energy transition and I'm looking at nuclear and some plays there, although there's not that many publicly, I mean, there are some, it's sort of secondary ways to get at it. I'm looking at solar, I'm looking at other energy sources. Nuclear is bipartisan, but as you say, we don't know if it's going to work.
And it's in the price, by the way, because those companies have been doing
very,
very well.
Solar's a little more, maybe more binary, depending on who wins in November. Like, how do you weigh all these things? How do you figure out what's the best bet?
We were at the RE Plus conference in Anaheim a few weeks ago on renewable energy with the focus on solar. There are 80,000 participants at that conference. It was like a circus. It was unbelievable. Solar is going to play a larger and larger role in the US energy system for sure. The question is, do you make any money owning solar stocks? And by the way, that's a completely different question. So solar may take off in the real economy. Owning the equities there may not be a good play for a whole bunch of reasons. I think as interest rates come down, by the way, owning solar stocks will be a very good trade over the next 6 months to a year. I think in the short run, natural gas is the big winner in all of this, in this increased power demand, because we know how to do that. It can happen quite quickly. US natural gas prices are quite low, and the US is going to be a major center for AI and this whole power boom. So I think natural gas is a place to play it in the short term. In the medium to long run, I'm very interested in the carbon capture space. If natural gas remains a part of our ecosystem, then I think the climate commitments will also stay a part of our ecosystem. So you'll need carbon capture for those natural gas facilities. And there are many ways to play that in the public equity markets. And I think if you look longer out, I'm actually very interested in the carbon removal space. Look at Microsoft. Microsoft is making all of these announcements in nuclear. Microsoft's also making a lot of purchases of carbon removal credits. They are 62% of the carbon removal industry is one company's Microsoft. They're actually single-handedly building that industry almost in the United States. Again, hard to play it in the public markets, but there are companies in like Climeworks, a direct air capture company. There are companies like Heirloom also in that space. There are biochar companies. There are all these businesses that are forming. We got to meet many of them during Climate Week. So there's a lot happening in this space. It requires investors to, A, follow policy, look at what people have been saying about these things for many years so you won't miss out on the nuclear moment like our clients hopefully didn't miss out on it if they followed our work. But also look at the industries that are going to be formed because of this power boom.
Try and get in.
And try to get in when you can.
Early on. Annika, we got to leave it there. As usual, I could talk to you for another 20 minutes. We got to leave it there. Thank you so much for being here. Appreciate it. Coming up, it's the Yahoo Finance Investor Playbook. We're taking a deeper dive into the fixed income space to tell you the best ways to position your portfolio. Stick around, more market domination still to come.
While the Fed's 50 basis point rate cut might have come as a surprise to some, traders now increasingly moving to price in a second 50-point rate cut in November and another rate cut from the European Central Bank next month. Shifts that were previously not base cases just a few weeks ago. We're looking at how to play the bond market with the Yahoo Finance Playbook. And joining us now is Michael Kushma, Senior Fixed Income Portfolio Manager at Morgan Stanley Investment Management. Michael, it's good to see you. So maybe start, Michael, with Jay Powell's comments today. Powell saying, listen, they're going to move over time to a more neutral stance. They're not in a hurry to get there, though, reiterating some of his prior comments about the economy, Michael. The overall economy looks solid, he said. Labor market's solid, but cooling. Did you hear anything surprising today, Michael, from Jay Powell?
I don't think there was. He's had a playbook in place since Jackson Hole, even since July, about being data dependent. And the data's moved their way over the course of the summer in terms of inflation has turned out to be lower than expected, and the unemployment rate higher than expected, which has played right into the hands of the idea of beginning to bring rate cuts into the market. I did think what was interesting was he talked about there's no rush to cut interest rates. There's no rush to get to neutral. So I think they have freedom to cut rates at this point, even another 50, maybe not all in one go in November, but 50 basis points more this year, just to get policy less restrictive. But I think they still think policy rates, at 4.5%, 4.25% will still be restrictive, still help them get to their inflation goal, at the same time taking the pressure off the economy.
So, Michael, when it comes to what people should be doing in the bond market right now, there's a bit of a conundrum because here the Fed is cutting, and yet you and other strategists, and we've been seeing it play out, yields haven't gone down that much. In some cases, we've seen them go up. So does that mean that people should not be sort of piling into, say, the benchmark 10-year right now with the hopes that we're going to see further price appreciation and yield coming down?
I think there is a danger that we won't see much price appreciation even as the rates come down. There's a lot of rate cuts discounted in the market today. In fact, the relationship between the Fed funds rate, the rate the Fed controls, and the 2-year Treasury note is as inverted as it usually ever gets. And that inversion usually only happens when there's a recession either imminently happening, going to happen, or we're actually in one. And we don't see a recession occurring. So there's a lot of good news about rates priced into the market. But we are likely to get rate cuts over the next 6 to 12 months for sure. The question is how much. So I think the 10-year yield is going to be trapped in a range, call it 3.5%, 4% for now, with waiting to see, does the economy really slow down into recessionary conditions? Then we will see further drops in 10-year bond yields, or do we continue having this a bit of a soft landing, 2 to 3% growth, inflation coming down, 10-year treasuries should probably stay around where they are. But it's not a bad investment, just don't expect big gains.
Let me ask you, Mike, about another theme I'm very curious just to get your take on is Chinese authorities announcing all this stimulus. You've heard some very smart people, Michael, kind of take both sides of that trade. There's been some big name investors saying, back up the truck, they're buying everything. We've had other smart strategists on Yahoo Finance who say, hold on a second, we've seen this movie before in the spring. And they announced stimulus, stocks pop, and then it fizzles. How do you think about this stimulus in terms of potential long-lasting impact on the economy over there and markets?
It certainly was surprisingly. The amount of rate cuts they put forward and fiscal stimulus they projected was a surprise relative to the conservatism that everyone thought that they had with regard to extra stimulus at this point in time. So it was a surprise, and I think there was such extreme pessimism about the Chinese economy and the Chinese stock market, they might call this a major short covering rally from current levels. Whether it can sustain itself will be determined by whether or not this stimulus can actually solve the problems that the Chinese economy faces, which is slow consumption spending, high savings rates, and a property market which is still under duress and is not yet in equilibrium. And in my mind, it's difficult to say this is going to solve the problem. It looks like it still will require more actions by the government down the road. But for now, it's taken the pressure off the financial system, it's taken pressure off the economy. And certainly the Fed cutting rates is giving more room for the central bank in China to cut rates without undermining the currency.
Michael, we've got the jobs report on Friday, and I know you're watching it very closely, as are we all. But you're looking for certain sort of thresholds in that reading, above and below which could be sort of pivotal for the market, at least on the day. We'll see how sustained. What levels are you looking at, and what are the implications?
Well, certainly a weak number. A weak number would be anything under 100,000. Which would continue the trend of recent months of deceleration and moving towards that zero level, which then you start worrying about layoffs and recession risks and things like that. So anything under 100,000 is probably going to ignite these fears again and ignite that optimism that the Fed will cut rates 50 in November and will even accelerate rate cuts in 2025 forward to the early part of the year. If we're right around the number, I think the consensus is around 140,000, even if we're a little stronger than that, as long as it's only a little stronger, I don't think the market cares, because the growth rate in employment and the unemployment rate have been going up in the last couple of months. So that some stabilization in that is probably a good thing, but will not stop the Fed from reducing the amount of restrictiveness in the economy. I think you'll have to see a blowout number, 200,000, in order to get the market to sit up and take notice that maybe the labor market's turned, and the economic growth we're seeing in the U.S. economy, which is 3% plus in Q2, yep, and probably Q3, will ignite stronger demand for labor in Q4 into next year, which will then take the pressure off the Fed to cut rates.
Michael, always great to have you on the show. Thank you so much for joining us.
Welcome.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from not only today's trade, but the month and the quarter. Yes, folks, it's the last day. Let's see where the major averages ended. In fact, everything turned into the green right at the end of the session. Even the Dow slightly higher on the day, up 17 points. That's after we saw this earlier dip following those comments from Jay Powell that seemed to throw cold water on the idea that we would get 75 basis points or even 100 basis points, as some economists had speculated, in rate cuts before the end of the year. He seemed to indicate, at least tentatively, that it would be 25 and 25. We'll see how it ends up. But the S&P 500 up 0.4% on the day. As you can see, that late day surge as we close out the quarter here, and the Nasdaq Composite as well, up about 0.4%. Also looking at the equal weight, which I've been watching closely here to see about the broadening in the rally, and that also squeaking out a bit of a gain there. There's one stock that I want to mention before I toss it over to Jared, and that stock is Apple, closing at a record today, up about 2.25%, and that's after a positive note out from JP Morgan. As you know, there's been a lot of sort of back and forth about how the iPhone 16 is going to do. That one seeming to inject a little more optimism into the scenario. If you look at Apple on the month, it hasn't been fantastic here, but again, seeing that enough push higher for a record, it looks like, when all was said and done. Jared's got a closer look at the action here. Hey, Jared.
Thank you, Julie. I'm going to start with the indices. I just want to show real quickly what happened this quarter, and then I'll move on to some heat maps. 64 trading days, one more than usual in this quarter. Here's the Dow, as you said, ending not only at its highs, but at a record high. Apologies for the annotations there, but nevertheless ending at a high. Nasdaq not faring so well. However, I would note, at least it is now in an uptrend, still has not been able to reclaim those record highs. 2.5% respectable for a quarter, and the S&P 500 5.5%, really respectable as well. All the more impressive given all the headlines we had and concerns regarding concentration. This was a quarter when a lot of the other parts of the market caught up. Here's the Russell 2000, a lot of choppy action, but still closing at the higher end of the range, up 8.6%. And now let's get into some heat maps. And at first blush, it might look like this was a defensive quarter, and you're going to see utilities and real estate in the forefront. Utilities now is an AI play, so that's something to think about. But also we did see a big reduction in interest rates. A lot of that accounts for it. And also we had some volatility shocks. We had that yen-mageddon. So I think all of that is kind of wrapped up. Only energy and tech very notably finishing the quarter in the red. And if I take a look at some of our leaders here, at the very top of the heap is KWEB. That is the Chinese Internet ETF. That just came to life a few weeks ago, so that's a very recent story. But what's happened, what's been kind of steady throughout the year is home builders. We can see home builders really taking off in this quarter. This is a year to date, and ending up 30% for the year, most of that in this quarter. And then we have regional banks, defense and aerospace. That just closed at a record high. Bets, low volatility, you name it. We had a lot of participation, just not necessarily from those chip stocks.
Jared, thank you. Stocks turning positive late in the session, but our next guest says the market is fully valued at these levels. Joining us now is Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Lori, always good to see you. So as Jared was just mentioning there, listen, nice run we've enjoyed here into that Fed meeting. We were expecting the cut. We got the cut. Do we keep just grinding higher here, Lori, the near to intermediate term, or no? We baked in at this point a lot of good news.
So look, I think it's a question of your time horizon, and I'm not trying to be overly cute here, but when we run the numbers on our valuation model, we think that we're already a little bit above where the market deserves to be for 2024. When we run the math for 2025 and we continue to bake in some good news in terms of inflation continuing to come down, 10-year yields that are behaving, and more cuts from the Fed, we bake in a slightly higher earnings number, right? Because earnings are expected to grow next year. Then we can get you to around, say, 6,200 on very conservative earnings for next year. So look, as I sort of look here through the end of the year, it's not my habit to make short-term market calls. That's just not what we do well over here at RBC. But I do think that, valuations feel a little bit full for the here and now, longer-term opportunity. Sentiment is also bumping up against levels that have, marked short-term highs. If you look back over the last couple of years, it would not surprise me at all to see this rally take a little bit of a breather. But we do have to, work through a number of issues here. And just because we think, we might be due for a rest, doesn't mean that we're bearish. So we just, always try to emphasize that it really is about your time horizons.
Hey, Lori, it's Julie. It is great to see you. So if we do see a pause and then the rally resumes, what is going to be the catalyst for that rally, right? Are we going to continue to see earnings expansion? Is it going to be the Fed continuing to cut rates? What do you think kind of juices it a little bit?
So look, I think that if you sort of look through challenges that we have to work through, I think one of them is we've got to get ourselves out of this economic pothole that we're in. And what I mean by that, we're just still seeing, too much conversation about what is the job number going to look like, people hanging on to every single word that companies utter, about the labor market and demand. I do think this is a tricky time. We're coming up on reporting season soon, and companies, are not really prone to give long-term guidance at this point in time, right? They're trying to wrap up the year. Analysts are going to ask them what's their outlook for next year. They're going to demur and say, come back to us in January and February, and that's not going to sit so well. I've seen this, game a number of times. So I do think it's just sort of working through some of those doubts. I think we've also got a lot of uncertainty around the election that we've got to work through. It is normal to see a bit of a pullback in the market in the months heading up into the election. And I think we also, we've already been anticipating, a lot of good news from the Fed. So I do think that that's, baked in at this point. Now, that's not to sit here and say you should fight the Fed, but it is not uncommon to see a little bit of a retracement in markets when you get to the first Fed cut.
I do want to pick up on that point, Lori, because we had a strategist on the show today who said, it's actually pretty simple. It's just the old tried and true maxim we all learn as investors. You don't fight the Fed. They're cutting. They're going to keep cutting. Is it that simple?
It's not that simple. And I think that's the problem, right, is when you have people who try to just sit here and say, it's simple, you should always do X, Y, Z. You miss some nuances, right? And even if you just want to look purely at the historical playbook, we looked at the past, kind of 4 major rate cutting cycles, and we found that you got a pullback in the market around 3 of them. Now, one you clearly, didn't get, so it's not a perfect barometer. But I also did another study where we looked at performance in the 12-month period after you get the first cut, and you tend to be up, and you tend to be up about 11%. So both of those things can be true at the same time. Again, it goes back to your time horizon. I personally am more of a longer term investor, but we are at that time of year when everybody tries to push you to make the short term calls. So, I think there's nothing wrong with sitting here and saying, look, there's usually some angst in the market when the Fed does start to cut. We're living through that angst right now. But at the same time, you do tend to see it end up helping over time. You may just have some wood to chop in a negative way before you get there.
Lori, the other angst-causing event, perhaps, for the market and in general is the U.S. presidential election. And one of the interesting charts in your most recent note looks at the betting odds, the average of the various betting odds from different markets on a Trump presidency. And we had seen it tracking pretty closely to the S&P 500. That changed over the course of the summer, really in late summer. Why did it change? What do you make of it? And what's the takeaway for investors?
So, it's interesting, Julie, because we've actually done that chart as well going back to the beginning of 2023. And so it's, 2023 and the first half of 2024, the market was just marching alongside Trump's odds in the betting markets. And we saw other interesting things as well, right? That if you looked at the growth value relative trade, it was tracking Trump as well. US relative to Europe was tracking Trump. And all those things have started to break down. And so I do think, number one, I do think the dynamics around the election have changed a bit. I think number two, if you sort of look at some of the policies that have been offered out by Trump, and I'm not sitting here and saying the market loves the Harris policies, but I do continue to see a lot of debate among investors, about the ramifications. So I think it's not as clear cut of, sort of a call by market participants as it was perhaps back in 2016. We do see a lot of investors concerned over things like tariffs and inflation, and thinking, I had one investor tell me, frankly, we shouldn't be looking at the 2016 playbook around Trump sectors. We should be looking at the 2018 one for the China trade war, which really reversed a lot of those, sort of cyclical sectors leadership. But I do think as well, just the rotation trade has really just sort of moved into the spotlight. And so you've seen these attempts at the market to rotate away from kind of those big mega cap growth names. And I think maybe that's just gotten to be a little bit more important than the political dynamics lately.
Say more about that, Lori, because I wanted to ask you about that sort of value growth differential that you alluded to. And obviously growth has faltered a little bit here, but how do you know when it's time for value, and where do you look to take advantage of that?
So if you look at the growth value relative ratio just in the Russell 1000, that's a pretty, easy thing that most people can pull up on their screens. And we've actually, we've sort of seen just very sideways choppy trading in that ratio recently, but growth is off its highs relative to value. So, we can sort of debate whether or not it's actually started and stalled. Growth is clearly fighting back though. So it hasn't been a clean, seamless, easy transition. I think there are a couple pressures on the growth trade, and I would sort of point to three things. I would say one, the positioning just extremely elevated. If you look at the CFTC data on Nasdaq 100 futures positioning as a proxy, it's been breaking through to new highs, and really, is above levels that we've seen mark a ceiling in the past. The other thing is you can look at valuation. And so when we look at the top 10 names in the S&P, they really have a bad track record in terms of their ability to be able to sustain a median PE multiple above 30 times. So they went up to 32 times over the summer and then moved right back down. They're still up around 27, but the rest of the market is trading at a median PE of about 18 times and has never quite hit, its sort of typical ceiling or typical peak. So I think you've got the valuation and the positioning pressures. Then you add on top of that decelerating growth rates off of astronomical levels. I've done this a long time. And when you see, superior growth rates start to fade, people get angsty, people get nervous, and the bar to outperform tends to be a bit higher. So what's the problem? The problem is that even though the Mag 7 earnings growth is decelerating, it's only decelerating on 2025 numbers to like 15%. And the rest of the market, while it's reaccelerating, is only reaccelerating to like 13%. So you just haven't quite been able to have this leadership handoff from the mega cap growth names to the rest of the market on earnings leadership. And I think that's why it just keeps going back and forth and back and forth. It's fading enough to make people nervous, but not fading enough to really make it clear that it's time to hand off to a new leader.
Lori, great stuff. Good to see you. Thanks so much for being here.
Good to see you.
Coming up, another big media acquisition has finally been confirmed. We'll get you all the details when Market Domination Overtime returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
DirecTV announced Monday it's buying rival Dish Network, ending decades of on and off talks about the satellite services merging. And joining us now with more is Yahoo Finance's Alexandra Canal. Allie.
Hey Josh, yeah, another big media merger has finally been confirmed here. And like you said, this isn't the first time that these companies have discussed a possible combination. Back in 2002, the FCC blocked a proposal to merge the two entities, citing antitrust concerns. But it's a much different story and a much different environment this time around. We have waning market power across the board when it comes to these satellite TV businesses. Subscriber losses have escalated. We see more consumers cutting the cord in favor of those more affordable streaming services. And because of this period of secular decline, analysts have really said it should be cleared by regulators once this kind of reaches that point. Now, once the combination is approved, it's set to create one of the nation's largest pay TV providers. DirecTV is currently owned by AT&T and private equity investor TPG after it was spun out from the telecom giant in 2021. Earlier today, though, AT&T said it would sell its entire 70% stake to TPG for $7.6 billion. Now, this allows the telecom operator to fully exit the TV and entertainment business. We saw muted AT&T shares throughout the course of the trading day, but we did see shares in EchoStar, which owns Dish Network, fall about 11% following the news. Now, as for what this all means for the future, MoffettNathanson analyst Craig Moffett said in a note to clients prior to the deal's confirmation that although consolidation during a period of secular decline is always to be expected, it would, quote, be a mistake to overestimate its importance. Adding a year or so to the expected life of satellite TV isn't going to change the narrative for programmers, distributors, or even for satellite TV. That being said, though, the deal is expected to help aid EchoStar's heavy debt load while also helping cut costs for the owners of DirecTV. Now, Moffett argues that for the rest of the media industry, this is going to not really move the needle since a merger between these two sides have pretty much been priced in. But I have heard from other analysts who say that because this is going to be the largest U.S. pay TV provider, it could potentially impact some of those negotiations for affiliate fees. So we'll have to see sort of what the ripple effect here is. But of course, this still needs to get through regulators first.
So much deal making in media.
So much deal making. It's starting, I think, throughout the course of this year. Into 2025, we're going to see that pick up a lot more.
Got to keep you on your toes. Yeah. Thanks so much, Allie. Appreciate it. Ramaco Resources has been looking beyond metallurgical coal, the company working on a unique opportunity involving rare earth element deposits. Now, China currently accounts for nearly 90% of global refined rare earths output. That's according to Semaphore. But as the U.S. tariffs on Chinese goods take effect, such as various critical minerals, we're looking at the state of the U.S. mining industry with Randall Atkins, Ramaco Resources founder, chairman, and CEO. Thanks so much for being here.
Thank you for being here.
So Ramaco is a met coal company. However, you acquired a piece of land and just happened to find some rare earth minerals. Now, for people who aren't familiar, rare earth minerals go into a lot of the stuff that we now use, that's come about because of technology, batteries and whatnot. So where are you in that process of getting that stuff out of the ground?
We like to call rare earths vitamins for electronics. And where we are in that process is we found a deposit somewhat by accident. Actually, the federal government helped us find it several years ago. And we've now determined sort of an approximate size, at least initially, which is a very large deposit, which contains mostly heavy and medium magnetic rare earths, which are very valuable. And where we are is we're now going through the analysis, which is sort of multifaceted with chemistry, with meteorologic and mineralogic testing, and then we'll have a techno-economic scoping report, which Fluor & Company is performing for us by the end of the year.
Is there even a rough timeline, Randall, when you all think, listen, this is when we think we'll be able to extract, produce, process these elements?
You bet. So I think the first step is to have some third party sort of independently confirm that they can be conventionally processed, which we hope to have by the end of the year. Assuming that's a thumbs up, then we would proceed to a demonstration plant, which we would start probably, it's in Wyoming, so we would start after the winter, probably take about a year. So we would hope in sometime, let's say 26, to be in some form of initial production, probably in a pilot stage.
And then who buys this stuff, right? Because as we mentioned, the vast majority of these minerals are now being produced in China. But of course, especially depending on the election, we don't know what the state of trade affairs between the U.S. and China is going to be. Would this all go domestically to production of items domestically? Because I don't know how much production occurs domestically that involves rare earths, or how much of it occurs abroad and then it's imported
Great
into
question.
the U.S.
So there's very limited production in the United States, and candidly, most of it does go to China.
Right.
So we have kind of styled ourselves as Team USA. So we hope, once we are in production, which would be a few years out, that we would focus primarily on U.S. domestic and perhaps some European customers. As a matter of fact, we just announced this morning we hired one of the Defense Department's research groups, DARPA, a gentleman from DARPA, which is the Defense Advanced Production Group, to come work with us, which implies that we would be probably talking to the Defense Department and other strategic groups as we go further down the line.
And Rena, how much does it cost when you talk about extracting and processing these elements?
So fortunately, we found our rare earths essentially in coal and carbon-based deposits. Most rare earths are found in hard minerals, uranium, cobalt, lithium, et cetera. Not only are they harder to mine, but they're radioactive. So that there's a radioactive tailings component to both mining it and then, more importantly, processing it, which is why most of this is all sent to China. They don't have the same environmental constraints about processing. So in terms of the cost, we think we will be able to conventionally mine this almost like a surface mining technique in the West, which is not terribly expensive. And then the trick really is the extraction and processing. And that's what you have to do an immense amount of testing, because this is not like the coal business. This is more like chemistry. And so we will be testing various solutions that will be the best to essentially separate the rare earths from the material that they're kind of aligned with. That's what we hope to have by the end of the year, is a pretty good idea on which direction and what those costs are.
All of this said, your primary business, I mean, really, your business is still met coal, still coal that goes into steel making. That business has, thermal coal has definitely shrunk in the United States, but met coal has been somewhat challenged as well. So talk me through the fundamentals of the business that, as it exists
Sure.
today.
So there's really three legs to this tool for the uses of coal. One is thermal coal for power, one is metallurgic coal for steel, and then we have a third leg, which is we call coal to products or critical minerals, which is what we just discussed on rare earths. As far as the metallurgic coal business, it hasn't really been challenged as much by anything domestically as by, frankly, the situation with the Chinese economy, because the Chinese have been flooding the world market with cheap steel over the last year by virtue of the fact that their economy has contracted. I know we had a bit of a mini bazooka last week, which has created some sense of a stimulus. But the fact of the matter is that the Chinese steel business is quite on its back. And by virtue of essentially dumping cheap steel around the world, they have also put most of the West's steel groups on their back as well. So if a steel company is in dire straits, they're not going to pay a lot for their feedstock. So as a result, the met coal prices have been down. But I think it's really reached probably about a bottom in terms of pricing. And we expect, for a variety of cyclical reasons and structural reasons, that probably this quarter you'll start to see the prices go back up.
I just want to sneak one more in then.
Sure.
U.S. Steel and Nippon Steel. Do you think, would that be good for the U.S. steel industry, the U.S. met coal industry? Do you think it's a good idea? Do you think it should go through?
I think whenever you can see a steel company in a stronger financial hand, that's probably a good thing. The amount of capital expenditures required to run, operate, and grow a steel company is immense. I mean, I think the numbers have been bandied about in the billions of what Nippon has said that they're going to put into the U.S. steel operations. I think that would probably increase steel production in the United States to some extent, which again would be probably good for not only U.S. steel operations, but of course for the met coal business as well. The U.S. has essentially consumed about the same amount of met coal for steel for about the last 15 years. So I don't think that there's like a spike that would be engendered by any type of M&A activity. But I think in whole, it's probably positive.
Randall, we covered a lot of topics in a short amount of time. Thank you, sir.
Appreciate it.
Appreciate you. Time now for What to Watch Tuesday, October 1st, sponsored by Tasty Trade. Starting off on the earnings front, Nike reporting first quarter earnings after close. Analysts expecting weaker sales for Q1, but will listen closely for any commentary on the company's recent CEO transition.
Shifting gears to the auto industry, monthly auto sales numbers for September coming out tomorrow. That number expected to come in at 15.6 million. It's an increase from the previous month.
And turning over to the labor market, we're going to be getting a new JOLTS data in the morning. That's the Job Openings and Labor Turnover Survey. Economists forecasting openings to tick up slightly to 7.69 million for August.
And moving over to the Federal Reserve, we'll get some more Fed commentary, including from Atlanta Fed President Raphael Bostic. Bostic told Reuters today that he is open to another larger rate cut if the job market weakens.
And finally, we could see the start of the port strike along the Gulf and East Coast at midnight. If the longshoremen go on strike, it will be the first time that all of these ports will be shuttered in nearly 50 years.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Stocks climbing with the Dow and S&P 500 closing at new highs, but the gains coming after a volatile session when comments from Fed Chair Jerome Powell drove the Dow down nearly 350 points. We're looking at the market's late session rally straight ahead. Plus, Carnival posting better than expected results for the third quarter, but the results not good enough for investors. That stock coming under some pressure in today's trade. We have Josh Weinstein, Carnival CEO, to explain that disconnect. And automakers facing a rough road. Stellantis, the latest automaker to slash its guidance. We dive deeper into the trend as to what's weighing on some of the world's biggest car makers. Carnival reported Q3 earnings before the bell, and despite a beat on EPS and record revenue, that stock was mostly flat today thanks to full-year guidance that didn't quite meet investors' expectations. Joining us now is Josh Weinstein, Carnival CEO and President, and Yahoo Finance's Julie Hyman. Josh, it is good to see you. So you look at this print, Q3 sales and profit beat. You raised the full-year outlook. Did look like quarterly profit outlook missed expectations, Josh. Walk us through the print and what you're seeing in the business.
Yeah, hi. Thanks for having me. Well, the quarter that just ended, our third quarter, was phenomenal. You know, we set records all over the place. It was in revenues and per diems and yields and customer deposits and operating income. So we felt real good about where we landed. We were able to take up our full year guidance as well. So now we've got the yields up almost 10.5%. And if you recall, well, you probably don't, but I do. At the beginning of the year, we had set our initial guidance at 8.5%. So nice progress on the revenue side, and then the cost side. This print, we were able to come out and say we're actually going to take our cost down by a point versus prior guidance. So instead of being up 4.5%, up 3.5%. So from a trajectory standpoint, we feel really quite good. You know, the fourth quarter, we're expecting continued improvement year over year. We got it to 5% yield increases. And last year in our fourth quarter, the per diems were up 10.5%. So it's a pretty high bar that we are lapping, and I think pretty nicely. So we feel real good. And as a matter of fact, all of these things, the output of that from an ROIC perspective, is going to be landing us at around 10.5%. And the beginning of the year, we had guided to 9%. So we see good progress, and that's really coming on the demand side.
Josh, it's Julie here. I was struck by something you talked about on the conference call. You said the goal is not an ever-increasing booking curve. And for people who have been watching what looks like this boom in the cruise industry, right, with these bookings getting filled up pretty far out, how would you describe sort of where we are in that cycle? And you also talked about sort of maximizing the profitability of the people who do sign up. So talk to me about your thinking through all of this.
Sure. So where we are at this point in time, our North American brands are actually at a record high. Our European brands, from a length of the booking curve standpoint, our European brands are the highest they've been in 15 years. What I was trying to get across earlier on the call is, you know, the goal is not simply to increase that curve for the sake of increasing it. It's really about getting that supply-demand balance right across really a 2 to 2.5 year period that these cruises are on sale for. And so there is a point in time, and I used an example, one of our brands actually is not higher year over year at this point. Their book position's a little bit lower, but that's intentional, because what they're trying to do is make sure they're not pulling it too far ahead and maybe leaving some price on the table. So this is organic, and it's changing all the time, and it is voyage by voyage, you know, ship by ship, brand by brand that we build this up, and our teams are trying to optimize. And really the end goal is, by the time that ship leaves and then comes back, how are we generating the maximum amount of revenue for that cruise?
Josh, I'm curious on that point, when folks are coming on board, how strongly are they spending right now, Josh, and what are they spending on?
Yeah, so it's a great, you know, you talk about trends and what you're getting into. Well, our consumer demand trends, we really haven't seen that slow down. So our onboard per diems for the third quarter were up about 6% year over year. And that's actually an acceleration versus the second quarter when they were up 4% year over year. So from a spend perspective, our guests are happy to spend on great experiences at great value. And that's really what we are. And so we saw that strength on both sides of the Atlantic. We saw it across deployments. So it really is broad-based. And you know, this is an experiential economy. People are looking to treat themselves well on vacation with their loved ones. This is a special time, and cruises line up very well to be able to capitalize on that because that's what we do. We sell experiences. You know, if you think about the onboard environment, what is it? It's bar, it's specialty restaurants, it's casino, it's spa, it's shore excursions, photo taking. I mean, all these things that really people are looking for, not the material things, but the memories. And that's what we deliver.
Josh, what about the build out of new ships, new destinations that are exclusive to you guys? What can investors expect over the next couple of years?
Well, what they can expect on the new build side is, for us, we have a very, very limited amount of capacity coming online, which is intentional. We have got one new ship in 2025, which will be the sister ship to the Sun Princess for the Princess brand, which is an amazing ship, an amazing platform. We have no ships in 26. And then we have one in each of 2027 and 2028. And that's it. That's the lowest order book for the kind of the next 3 years out that we've had in pretty much anybody's memory. But what that means is we're focused on same store sales. So I'll give you an example. In the third quarter that just passed, that we just closed on, our yields were up 8.7% year over year. If you back out the new ships, which are amazing, that we had this year versus last year, our yields are still up 8%. So we're really focused on making sure we have that demand profile for the same store sales so we can really optimize that revenue growth. And so that's where the focus is. Now, on the destination side, we're very excited for two really big initiatives that we've got. One is Celebration Key, which is coming online in July of 2025. It will be the first destination that we are purpose building for the Carnival Cruise Line brand in particular. It's going to be able to accommodate 13,000 guests a day when we first launch, and we've got plans on the land side to be able to almost double that over the remainder of the decade. So that's a huge opportunity for us, not just because it's going to be a great experience, but because it's located so close to the eastern seaboard of the United States that it's going to be an amazing fuel savings for us as well, because we can get there by going shorter distances and slower. So that's going to be able to allow Carnival Cruise Line to have 19 of its ships have Celebration Key on its itinerary from about 10 different home ports, which is a really phenomenal asset for us. And then in the second half of 2026, we're going to be able to do some upgrades that we'll be talking about shortly on Half Moon Key, which is a private destination that we currently own and operate. And it is beautiful. It is pristine. It's white sand. It's crescent-shaped beaches. And we want to keep it that way. But we're going to be able to allow for more guest throughput because we're building a pier that's going to be able to accommodate two of our biggest ships at any one time. So there's a lot of wind at our backs as we look over the next few years.
Josh, always good to have you on the show. Thank you so much for joining us. We appreciate it.
Thank you.
The Dow and S&P 500 hit fresh records to cap a strong September and quarter. Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Josh.
Hey, Josh, yeah, so we got a fresh record for the S&P 500 and Dow, like you said, but it did not look like earlier in this session that was going to be the trajectory for stocks. So I want to focus on what Fed Chair Powell had to say today. Chair Jerome Powell saying that he does not see this as a committee that is in a rush to cut interest rates. That seemed like a key part of his speech earlier. And what those words did, Josh, was it had the markets maybe expecting a little bit less as far as Fed easing goes. So if we take a look at what the CME Fed Watch tool is pricing here, this would be 25 basis point cut. This would be a 50 basis point cut, so a larger cut. You can see market now favoring 25. This was about a 50-50 split going back a week ago. So market's clearly moving on what Powell had to say. Stocks took a dip lower. If we take a look at where the markets closed today, it's going to take me a second to get there, but the S&P 500 had been about flat. You saw a big move downward when we look at the intraday here. And then it came back up, right? So this was Powell speaking right here, Powell's comments right about here, big move down. But what I think is interesting to remember here, Josh, he's saying maybe less cuts. Well, the economy is in good shape. How many strategists have we talked to over the last 6 months that have said, if we get less Fed rate cuts because the economy is good, things like this might happen. A good economy is good for stocks. And maybe the market sort of reasoning with that and sort of bantering back and forth with itself as we carry through the day with it.
Yeah, reiterating that key point, the overall economy, his point was was solid. And if you look at, I mean, you can understand where he's looking in jobless claims, retail sales would seem to support that. And basically, I thought it was interesting reiterating that point. Also, labor market, he said, solid though cooling.
And it's a big week for the labor market, right? And we're not going to really know. We're going to get so many more data points. You and I were talking about this until that November Fed meeting that Powell talking today, he might sound different in 3 weeks. I don't know how much you should really read into those CME moves that we're talking about. But one thing that's going to be interesting is that Friday jobs report. So here's what we're looking at here, Josh. This is from Bank of America. This is implied moves in the S&P 500 using options. So you can kind of take a look at where investors are pricing in the largest moves over the next month. Obviously, this one popped off the screen, right? The election. But what I thought was interesting was when you remove the election, NFP, non-farm payroll. So that's your first jobs report there, your second jobs report here. Those are expected to be the two biggest moves over the next month, again, outside of the election. So it seems like labor market data really going to be what's driving the stock market action from a macro perspective over the next month.
We had strategists who said, in terms of levels they were watching, kind of like if the number comes in as expected or a bit above, that's fine. Below 100,000, they thought you could reignite some of those growth worries we saw in early August.
Yeah, it seems like we're expecting cooling, right? So 130,000 is not a blaring hot number, but anything under 100, like you said, that's kind of cold. Instead of cooling, that might be actually slowing. And so maybe that's where you get some fears. Also, that unemployment rate, if it goes back up to 4.3%, there'll be some debate on exactly why it's going up, where the rounding is. It's going to be an interesting report because I'm not sure the move we get instantly is going to carry throughout the day. I think there'll be a lot of nuance with it.
All right, Shay, for number 3.
Final takeaway. It's the end of Q3, so I just wanted to look at what led and what lagged in the third quarter. Really, the takeaway for me here, of course, you've seen utilities, right, all year long. It has been a year for utes. It's been crazy. But really, what you're seeing, utilities, real estate, industrials, materials, financials, this is a lower interest rate trade. This is the economy is doing pretty well trade. And then you look at what lagged, comm services and technology. The winners of the last year and a half didn't have a good third quarter. And I think we're now at a point entering earnings season where the question is, did these guys lag enough for people to come back in and buy tech? Jay Woods was on our morning show earlier this morning on Wealth in our 11 a.m. hour, and he said he thinks tech might have lagged enough at this point that might be where people rotate to next. He's like, tech hasn't been loved for a couple months. People love to go back into those big tech names, maybe around earnings. If they report well, you'll see rotation back into those large caps.
And strategists also point out, Josh, like if you look at why we rally like this, obviously it's the rate cut expectations, but also, and you've brought this up too, about these expectations that actually we see earnings growth outside of big tech.
Earnings growth has been good for everyone outside of big tech. Last quarter, supposed to continue again in the future quarters. And then, you have rate cuts, you have dovish Fed, you have a relatively solid economy. A lot of things that add up for a broad rally right now. And really just the question is, can we stay on kind of that ideal trajectory? For now, the market says yes.
All right, wait and see. Joshua, thank you. Stick around, much more asking for a trend still to come. Profit warnings from Stellantis, Volkswagen, and Aston Martin all warning about profits as the auto industry continues to struggle. For more on auto industry trends, we're bringing in now Kevin Roberts, Director of Industry Insights and Analytics at Car Gurus. Kevin, it is good to see you. So let's start there, Kevin. So these profit warnings that certainly got a lot of attention, Stellantis, Volkswagen, Aston Martin. Are there common themes and trends sort of underlying those profit warnings, Kevin?
Yeah, I think what you're really seeing is reaction to what's developing in the two largest auto markets. So the first one's China, which is seeing a shift towards lower priced, NEV type vehicles by local manufacturers. And that is obviously having volume implications for your, traditional domestic global automakers or traditional global automakers. And then when you look at the U.S. market, it's really a situation of oversupply, particularly for select automakers. Stellantis is one of them, where they just have too many vehicles sitting on dealer lots. And that's leading to an oversupply and leading to, concerns about sales demand and having to increase incentives, which could impact profitability.
Let me ask you about another potential challenge, Kevin. This potential port strike we could be looking at, how could that potentially impact the industry?
Yeah, thankfully, the industry is in a much better inventory situation than it was 2 years ago. When you look at sales, roughly 3/4 of sales are coming from USMCA, so likely wouldn't be heavily impacted by the port. And then also about 3/4 of any import sales are coming from countries that likely would be coming in on the West Coast, which isn't going to be impacted by the port situation. So initial impact, I don't think would be large for most consumers. But the automotive industry is a largely global industry, so any kind of long-term strike there could have a more prolonged impact on the industry.
And Kevin, another trend I want to get your take on. The Fed obviously, starting to cut rates here. What could that mean, Kevin, for affordability and auto sales?
Yeah, affordability is clearly top of mind for consumers. We can see that with searches on our site. And so while, a 50 basis point cut from the Fed is welcome, I don't believe it's going to have a large impact on vehicle prices immediately. We likely need to see more sustained cuts from the Fed in the coming months and years to really reduce vehicle prices that could really offset the really significant prices we've been seeing, increases we've been seeing for new and used vehicles.
And Kevin, Tesla Q3 delivery numbers this week, front and center. You look at that market, Kevin, getting tougher. The traditional car makers have moved in, new models, fresh models. What does the competitive landscape, in your opinion, kind of look for Tesla here?
It's definitely become more challenging. They were the first mover in the space and really were able to take advantage of that. We're seeing more and more automakers bring new EVs to the marketplace. And those are fresher models. Tesla has a pretty unique product refresh cadence, which means some of those models have been out for quite some time and might look a little stale compared to other makes and models coming out into the marketplace. And additionally, a lot of the demand that we had initially thought might happen for electric vehicles this year is transitioned to hybrids instead. And that's a powertrain option that Tesla doesn't feature by design. And so a lot of that growth we've been seeing for, kind of alternative powertrain vehicles out there is happening with hybrids. And that's just something Tesla can't take advantage of in the market right now.
So that's interesting, Kevin. Hybrids, they're as hot as ever?
Yeah, hybrid sales, looking at the sales data, looks like they're up 30+% year over year, year to date. So it's a really interesting market right now. Consumers are clearly looking for a fuel efficiency. But they're looking at hybrid powertrains instead of EV powertrains. EV sales are up, but not up nearly as much as hybrids.
Kevin, always good to see you and have you on the show. Thanks for joining us.
My pleasure.
Stick around. We're asking for a trend right on the other side.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
For months, the S&P 500 would move in tandem with former President Donald Trump's odds of winning the election. But as those odds have slipped, the S&P is moving in the opposite direction. Yahoo Finance's Julie Hyman joins me now with a closer look.
Yep, that's the chart of the day here, Josh. So indeed, we're looking at the S&P 500 here in blue. We've got the average of the betting markets here in purple. And this chart coming to us courtesy of RBC's Lori Calvasino, who pointed out that indeed we've had the betting odds go down to some extent that Trump would win. And you've seen a decoupling of the two lines. And she says it's sort of come as a result of more of a debate over the two potential presidencies and what they could potentially mean for the markets, and that it's not a clear-cut answer which would be better. She also said when you're looking at trying to compare markets here that you may not be looking at the right model. Here's what she told us earlier.
I had one investor tell me, frankly, we shouldn't be looking at the 2016 playbook around Trump sectors. We should be looking at the 2018 one for the China trade war, which really reversed a lot of those, sort of cyclical sectors leadership. But I do think as well, just the rotation trade has really just sort of moved into the spotlight.
So we've seen rotation, we've seen other factors, of course, affecting stocks, but that led me to then look at what we saw in 2016. You had the election sort of around here, and then stocks went higher. In part, it was a surprise, right, to markets. It was a surprise election. And so you initially saw a drop, and then stocks recovered as the feeling was, well, a Trump presidency would be positive for a corporate tax regime in particular. Then in 2018, when you did have a congressional election and Democrats taking control of the House, that was one factor. But the other factor, as Lori pointed out, was the imposition of tariffs. So there, rather than seeing sort of that increase through year end, you saw a fade to year end. What's going to happen this time? We don't know. Nobody really knows, but you are seeing sort of how stocks are trading is that it is not a foregone conclusion that a Trump loss would be negative for markets, Josh.
All right, Julie, thank you. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.